This stock is down 53% year to date. It's down 32.8% since last year. It's a company with a forward PE of 16.5 times, EV to sales in the next 12 months 1.8 times, and EV to EBITDA 6.9 times. It's a company that is expected to grow revenue 32.3% in fiscal year 2024, 29.7% in fiscal year 2025, and 23.6% in fiscal year 2026. EPS for this fiscal year is expected to be down 23.4%, so now you can already start to guess why the stock is down so much. But then we see a clear reacceleration, close to 50% year-over-year growth in fiscal year 2025, and then another 30% year-over-year growth in fiscal year 2026. The company is called DLocal. Now, DLocal stock has been hit quite hard more recently. Actually, the biggest hit happened in the last 3 months. In the last 3 months, the stock went down 47.3%. But if you look at forward PE, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth, to me, this is extremely cheap, especially since this company is still growing and growing quite fast. Yes, it's true that in the short run, profitability side of the business is taking a hit. Yes, it's true that there was a short report talking about if their financials are 100% correct, if the auditing is done correctly and stuff like that, if it's not fraudulent, let's say. So of course that adds to the pressure of the company and adds to the pressure of the stock. But with the recent restructuring in the management, I do think that most of these fears should go away. Yes, again, in the short run, profitability side of the business is getting hit because the company is reinvesting a lot in the business for future growth and for future stability. We've seen that with Edion in the past, actually almost a year ago. Stock crashed 50% in a matter of a week or two. Yes, I agree, Edion, much stronger company. The stock did crash a lot extremely fast, then saw a rebound when the company basically reiterated their forward guidance when they provided a bit more business updates. Again, different styles of companies playing in, let's say, the same markets, but one is a very, very big, more mature company, which is Edion. The other one, DLocal, still quite small, dealing in the other parts of that market, more emerging markets. With all of that said, I do still think that DLocal is a great business, market cap of just $2.3 billion. If you know their total addressable market, if you see how fast they're growing, I mean, $2.3 billion in market cap, to me, it's still a small position in my portfolio, but I do think that if it works out, it's going to be quite a big return. That's just my opinion. Now, if you enjoy this type of videos, by the way, first share your opinion down in the comment section below. Hit the like button, subscribe, notification bell on, do all of that. If you want to support me even further, do check out the link down in the description and in the pinned comment, get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. One last thing here is the average analyst price target still sits at $13.86, which represents 69% upside from the price we're at today. And it's not like analysts have not changed their mind. Actually, the stock has gone down and analysts have gone from an average back in early May $18.27 to now $13.86, which again, still much, much higher than the price we're at today. Moving on to a quick recap of what happened in Q1. So record high TPV in Q1, profitability was impacted by seasonality, top merchant pricing, business mix, and OPEX investments for future growth. So we've seen here TPV volume up 49% year over year and just up 4% quarter over quarter. Revenue is up 34% year over year, but down 2% quarter over quarter. Gross profit only up 2% year over year to $63 million. That's already where you're seeing the negative impact, down 10% quarter over quarter. Same with adjusted EBITDA, down 19% year over year and 25% quarter over quarter. Moving on to revenue breakdown by geography, they show us this, I think, also for gross profit. I mean, transparency has definitely improved. So comes at no surprise, Brazil is still the largest chunk. Latin America is basically the largest chunk, but in that category, in that geography, should I say, Brazil is the largest one, of course, down quarter over quarter. Q4 usually the stronger quarter. Argentina saw a reacceleration. Of course, Argentina has been taking a big hit. I do think that now with the new president and things looking a little bit better for the Argentinian economy, I do think that that side could see some further progress. But the, let's say, more volatile part is definitely Africa and Asia. Despite revenue being up quite a lot since Q3, we can see that Nigeria in Q4 had a strong quarter. Then in Q1, extremely weak one compared to Q4, and then even compared to Q2 and Q1 of 2023. Same with Egypt. So these are the parts of the business that are still quite volatile and that will definitely impact the company in a negative way. Things aren't going the right way, and in a positive way where you get some good surprises. It also depends on the currency of those markets. So you have to take all of that into consideration. And since this company is still quite small, not generating billions and tens of billions of dollars in revenue, then yes, these types of things will impact an earnings report. Now, the performance of the strong TPV for the quarter, we have seen remittances up 94%. We've seen SaaS up 54%, ride-hailing up 55%, and commerce grew 195%. Turning to adjusted EBITDA and operating profit, you can see that it's been now 2 quarters in a row that we are down from an adjusted EBITDA perspective and from an operating profit as well. So it's a quarter-over-quarter impact on adjusted EBITDA and operating profit, mainly driven by gross profit contraction and OPEX investments for sustainable future growth and long-term cost leverage. Of course, right now it's all talk. So the business takes a hit, the stock takes a hit. They say it's for future, it's for this and that reason. Okay, fine. But then eventually they will have to show positive results. They will have to show that once, let's say, they stopped investing so much, then suddenly the business starts looking much better. Whenever that will happen remains to be seen. They gave us some comments for the gross profit decline. So we decided to sustain our planned investment increase that support long-term growth. So first we saw one of our largest merchants achieve a new level in our tiered pricing scheme and also renegotiate fees as their contract came up for renewal. Given the still high concentration on top 10 merchants and that the business has, such a renegotiation directly impacts revenue growth. By the way, on the topic of top 10 merchant, you can see that it has come down this quarter, not by a lot. I mean, it's still quite high, but at least now we're seeing that trend come down. Let's see if that downtrend can continue. Yes, in this case, the downtrend is something good. Second, product mix shifted towards lower monetizing payouts volume as core pay in verticals such as e-commerce and advertising are typically seasonally weaker in Q1. Additionally, a few important new launches that were scheduled for the first quarter were delayed by our merchants, something that we don't control, and slowed down anticipated volume ramp-ups that should have offset those declines in take rates caused by the above mentioned events. And I do think that we should see this in Q2. So that could have definitely a positive impact on that quarter, which by the way just ended. And so turning to full year 2024 outlook. TPV between $25 and $27 billion, gross profit between $320 and $360 million, and adjusted EBITDA between $220 and $260 million. And by the way, the respective midpoints imply adjusted EBITDA over gross profit of around 70%. For this quarter, or Q1 should I say, EBITDA to gross profit margin was 58%, so they are expecting an improvement in the second half of the year. Midterm outlook, they reiterate their midterm outlook, gross profit CAGR 25 to 35% and adjusted EBITDA over gross profit margin of over 75%. As we look beyond 2024, once we conclude our short-term investment cycle in tools, processes, and people to secure our ability to scale the company effectively for long-term growth, we believe we will start to see the operational leverage inherent to our business model kick in more clearly. Like I said before, the moment they stop. The moment they reduce, let's say, this investment cycle, you should see the core business, I would say, flourish if it works. And so looking at the graph right now, it seems that we might have found maybe a bottom here in no man's land, by the way, $7.50. This might be a rebound area, a bottom for the stock. RSI still very much oversold, but we have seen a good green candle last week. This week started green as well. We're now trying to get over, or at least try and end the week above the 20-day moving average. Don't forget, it's a short trading week with the 4th of July being on Thursday, so the markets are closed. And the day before, so June 3rd, it's, I think, an early close. So yeah, not that much time for this week, but let's try and finish above that 20-day moving average. That should be something positive for the stock. But overall, the market will still be looking towards a bottom when it comes to the profitability side of the business. When will that downtrend end? Are we seeing some stability in the markets that they're operating in? Can they give us more insight towards when will that investment cycle end, to then maybe see some positive projections in the coming quarters? That's all right now. Of course, painful time for the stock. It's up to the team to execute correctly and to show the market that, look, our way to do stuff is working. We're fully committed to that. We're also seeing some improvements in the business, so patience is needed. Remains to be seen. I will, of course, update you in the upcoming earnings report. We still have time for that. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.